Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. Today on my podcast, I have Lorne Andrews on again. Lorne is a broker owner, broker founder of the successful Expert Financial mortgage brokerage, working across Ontario. Welcome to the podcast, Lorne.
Thank you so much. Awesome to be here again. Thank you for inviting me.
It's always a pleasure. Last time, for those of you who haven't listened to our podcast, we had an amazing conversation on co-ownership. I thought it was very insightful. There's a lot of things I learned, and so if you haven't checked it out, definitely something to check out now, especially with the times. So definitely go take a look at it. I'm going to be leaving a link below. Today, though, I wanted to do a little bit of a different conversation. I wanted to talk a little bit about, at least get started on interest rates, what to expect, and how to prepare, what Lorne's kind of perspective is on the real estate market, and whether we should buy, whether we shouldn't, what should we be thinking about if we're doing any of that. But to kick things off, Lorne, I mean, it's just been a heck of a roller coaster ride. Last year, towards the end, I'm reading doom and gloom by RBC. Today, I think within the last few days, they said everything's going to be really rosy. You had banks that were thinking everything's going to be great. Now are saying we're going to make our portfolios smaller. Bank of Canada first said, I think last year, that they're going to not raise interest rates anymore. They raised it again. Now they're saying stop, but the Fed says they're going to keep going. I know this is just a load of information for all my listeners, but I'm sure you've heard of this before. What do you think is going to be, and this is a crystal ball question again, but what's your kind of perspective of where interest rates are going and what to expect in the next 6 months and the next year or so?
Okay. This is where we do the disclaimer that anything I say is because, it's been a whirlwind in terms of where, what's sort of transpired over the last year. And I think, part of our biggest challenge, and I think you'd agree with this, is anything that's newsworthy is usually the doom and gloom side of things, right? So they talk about interest rate hikes. Interest rate hikes is going to go up, and it goes up and up. So, and it's interesting because I was at a conference with a bunch of realtors, and one of them said, how are things right now? Are you not busy? Are you busy? And I said, things have really gotten busier because of all the interest rate decreases. And he looked at me and he said, what do you mean? And I said, well, most of the fixed rates have fallen almost a full percentage over the last, 4 to 6 weeks. And he's like, what do you mean?
Yeah.
Problem is because you hear, the government's trying to fight inflation, and they're saying they're going to stay pretty steady with their policies until we reach a 2% inflation, right? And so you see prime being increased, which affects everybody's variable rates and everything else. as that goes up and up. But you have to keep in mind that there's sort of two sides of interest rates. There's your um, the prime, which is really relative to what the economy is doing, and then you have the fixed rates, which are really dictated by bond yields, right? So
Mm.
there's two safe investments in this world. One is mortgages, and one are bonds, right? So when bonds start to pay more, they have to raise the fixed rates to compete with those bonds, so people don't de-invest in mortgages and invest in bonds. But when bonds start to come down in terms of what their values or what they're paying and their interest, then they say, oh, we can now lower our mortgage fixed rates as well. So where you used to have, mortgage rates above, say, 5.3, 5.4% a month ago, um, now, some of the fixed rates are as low as, say, 4.79%, things like that.
Yeah. Oh
Uh,
wow.
yeah, so this is the stuff you don't hear. And when we talk about where interest rates are going, so it's I have some conversations with some buyers that are saying they really loved it where interest rates were a year and a half ago, and to say
Mm.
we're going to wait until interest rates get back down to there, and then we're going to purchase. And I'm like, I don't laugh. But the government's laughing because it's like they'll never get down to where they were before. They realized they made a big mistake putting them down as low as they did and for as long as they did,
Yeah.
and it sort of helped this whole situation with the housing and everything else, and pricing and everything else, where it has this domino effect.
Yeah.
And so they're saying, hey, listen, rates might come down, right? And they will come down. They're not going to be as high as they're not going to stay this high forever. But I would expect that there's not really going to be much of a change, especially when you talk the variable rates and everything else, for the next year at least. I don't anticipate they're going to reach their 2% in 2024 at all.
Yeah.
Um, and what's happening with the fixed rates right now, they have stabilized. So they've came down. They went up again just a little bit. Um, but people are saying, okay, why would I pay close to 6% for a variable when I can pay 5.1, or close to almost a percentage less by doing maybe a 3-year fixed,
Yeah.
maybe a shorter term, right? Because they think, okay, if this is going to last 2 or 3 years, why lock into a 5-year term when I can just let me sort of anticipate when this could potentially come down a little bit, and now maybe think of more of a shorter term fixed rate. That way
Yeah.
your payments are the same. But as far as the outlook of where things are going to be going, I wouldn't say that I would anticipate there's going to be much changes to the rates, especially in terms of a decrease over the next year.
Yeah. I mean, for the record, I don't think that where the interest rates right now are too high. I mean, they were too low before. We're looking at more of a normalized market.
Yeah.
It's closer to normal now than it was a year and a half ago, because that was just unprecedented. It was easy money. Everything was going, and it has effects on an economy, not just housing. I mean, if you have cheap credit, there's more people buying cars, naturally more car dealerships opening up and all of that. And so there's structural changes that need to kind of go back to more of a normalized perspective, or normalized state, where interest rates are at a rate where you're not giving away easy money or negative money, where interest rates aren't lower than the inflation rate, which is negative money. So it's something that we're like right now, for example, I don't think we're too high. But to what you're saying you should have, if you're going into a 3-year, thinking that the rates are going to change or the economy is going to change. Are you expecting them to come down then? Is that what your kind of perspective is? But if they're coming down, then where do you think they're gonna? What's kind of the norm that
Oh,
you're kind of expecting?
yeah, and that's a really that's the golden question right there, is what is the norm going to be? Because the norm will never be what it was before, right?
Yeah.
And I'm probably anticipating rates might come down, maybe 0.5%, 0.75%, and that's going to probably become the new norm.
Yeah.
There was when our rates were relatively low. Let's say our rates were about 3%. I was at a conference down in the U.S. and I there was this U.S. mortgage broker beside me. I said, just out of curiosity, what are your rates right now? He goes, oh man, he goes, they're at an all-time low. We're at 5.25%. And I'm thinking, huh.
That's
They're excited
perspective.
about 5.25%, right? It's like, and he is so excited because business just booming down in the U.S. But that's what they're used to, right? Because
Yeah.
they were used to 7, they're used to 6, so 5.25 was a golden treat for them, and we get used to it too. We got used to the rates being 3%, and that's not something that was normal. Even before COVID, like I believe it was the prime was close to 4%, right? So
Yeah.
the variables were up there, right? Not they're lower than they are right now, but before COVID, business was great. Real estate was doing really, really well, but interest rates were much higher than when it fell during COVID.
Yeah.
It's just now we've seen a particular jump, and I think where the advantage for the home buyer right now is because if you take your focus away on the interest rate, because again, you're going to date the rate, right? You're
Yeah.
just dating it. It's not going to be permanent, okay? But that price of the home that you're going to purchase, that's what you're going to marry, okay? So that one is going to stay the same. And there was just a report yesterday. There's some pockets in Ontario that have come down almost 40%
Oh,
in
wow.
over a year. In GTA, it's about 20%, right? So would I want to pay a 20% if I'm going to get my home maybe discounted by 20% and pay a higher interest rate? My carrying cost is going to be pretty much exactly the same as it was a year ago, with because I needed 20% more of a mortgage, even though the
Yeah.
rate was 3%. So my carrying cost in that home is probably going to be pretty much identical. Um, but I just got the house at the adjusted price. Okay, so I'm thinking as a buyer, um, I want to buy at a lower price as
Yeah.
opposed to a higher price with a lower interest rate. I'm only dating that rate, right? And that's the thing that we got to keep in mind, because even if the rates are a little bit higher, and say, okay, these are what our payments are going to be after 3 years, and if it adjusts by 3/4% or 1% or whatever it is, we know our payments are now going to drop. Okay,
Yeah.
I got this house at a lower price.
Yeah, no, and I have the same conversations because I have people coming to me and they're asking, you know what, like, um, interest rates are so high. Like I'm going to be paying so much interest on a house. But my conversation is similar. It's like, okay, do you want to be in a situation where you buy a house for 500, $800,000? I mean, you can't buy a house in GTA for 500,000. I'm hoping somewhere, but 500, 800,000, right? And the interest rates are go down, and now your payment goes down, or do you want to buy a house for $1 million and interest rates go up? And it doesn't change the principal that you owe. The principal always stays the same, like you're just saying. You marry the principal, so you're marrying the price. So it's not going to change, and now you're just paying more. So now is the time that you got to jump in. Now their next kind of response to that, and I'm going to let you. I want to know how you'd answer is, if that's the case, then I'm waiting for the market to bottom out. And so when I can get the cheapest, because you know what? What if I get something and interest rate goes up again and my house now becomes cheaper? So what would your kind of response be to somebody who's kind of giving you a response like that?
So I hear it too. Okay.
Yeah,
And the problem is when you're trying to time the market, the only time you're going to know is when it's already on its way back
yeah,
up. Right. And you have to look at, there's other factors that are involved here right now. So if we look at housing inventory, okay, so we look at, how many houses are on the market, and people might say, no, I see for sale signs more often now. You see them more often because the buyers have slowed down a little bit. The houses are on the market for more days on the market right now.
mm,
Um, but you also have to understand that the needs for housing right now are still big. Like we talk about rents, like how much are rents now? Are they going down? They're not, because
yeah,
inventory on rental is low. So people are saying, geez, if this is how much my rent's going to be, if I can get a house for the same price, why not get the house, right?
Yeah.
If it's because the other challenge, you're going to say, okay, well, how do I get the down payment? But we talked about, for example, you mentioned earlier for our previous session, we talked about the shared equity where they'll give you you only have to have 5%. They'll give you the rest to give you that 20% down payment. So there's down payment solutions, okay, that are out there, okay. So the thing is right now, if we wait any longer, as soon as there's a little bit of an adjustment in interest, okay, let's say it does, if inflation starts to stabilize, it gets close to 2%, and the government says, okay, we're going to cut the prime by 0.5%. Just the signal is going to say, okay, this is the way interest rates are going to go, and what's going to happen is going to be the catalyst for buyers to now say, okay, we're going to start buying. What will happen at this point is the limited inventory that's out there is going to evaporate, right? Because
Yeah.
those houses would be gone. Now what's going to happen is you go back 2 years ago when you're getting 20, 30 offers per home because there just wasn't a lot of inventory. House prices start to go back up because supply and demand, right? And now you're overbidding, you're overpriced, you're buying houses that are 20% more than the value that they are right now. And for sure this is going to happen because even with, we have so many new to Canada people coming in. We
Yeah.
have 570,000 last year, another 430,000 this year. New builds are totally behind schedule in terms of just keeping up with the demand of influx for what's needed for housing. A lot of them been suspended, costs and everything else. They're just not keeping up. So we know there's going to be a huge demand surplus, right, in terms
Yeah.
of relative to the supply, and what happens then, right? Even right, and to your point that you're asking before, um, you know, we have 3 of my last buyers that I'm working with have lost out to more than 10 offers on homes. So I
Oh
can
wow.
see the signs starting to happen again,
Yeah. Yeah.
right? So if you want to wait to time that market, like now's the time. Time
Yeah.
is now. Like
Mm.
it is because I can see what's happening on the other side too, and I know a lot of people don't get a chance to see that. But it's just like my message that I'm trying to get out to anybody that's considering buying right now is like
Yeah.
now is the time, right? And I'm not saying that for any other reason other than we want to help impact people's lives, want to help people get into homes. This is what we like. There's that feeling when they're holding the keys and they send you that picture of them holding those keys and they get the kids are getting their own rooms and all this
Yeah.
stuff. That's a great thing, right? We want that to
Yeah.
happen, but
Yeah.
I'm really worried. I am actually really, really worried what's going to happen. Again, as soon as there's an adjustment in the interest rates, it'll
Yeah.
take a long time to get caught up.
Yeah, and I completely agree with you. Just because I feel like whenever somebody says that to me, I say it's pretty much the same stuff, and I tell them, listen, like if once you know, like you said, where the bottom is, it's going up, and it's going to go up much faster than it came down. You're not going to have time to think when it's going back up. It's just going to be, just like you said, bidding wars. We're going to see some of the same conditions, and I think a lot of people where they're mistaken is they look at our neighbors down south and like, well, you know what, house prices fell there, but there's a lot of other things that are different from the States versus Canada. In the States, when house prices fall, market kind of in an area in a state goes down, rents come down too. We don't see that here. The rents have gone up, and we're seeing record rents. And so in Toronto, there's still people paying, what is it, like up to 50% of their paycheck goes to rent. There is there is still a increase in rents, which shows that there is a pent up demand that is waiting to be released. Everybody's kind of on the sidelines waiting, whether they can afford it now, they're waiting to get into the market, or whatever it is. There is a lot of kind of demand waiting that as soon as they feel, for whatever reason, it's easy to get credit that they can jump in, they're going to jump in. And all of a sudden, you're going to see that there is no inventory for anybody. We're going to have less inventory than we did a year and a half ago with the 30 or whatever offers. There's not going to be that many inventory because back then, like you said, There was new builds coming out. That was absorbing some of the demand. You don't have that now. You don't have new builds absorbing as much of the demand. I think the last few months, the new builds being sold was like single digits or something. I don't know what it was. It was just being booked. It was next to nothing. And so, or projects starting. So for people to kind of understand that now is the time. And by the way, just for the record, for all of my listeners, I mean, I put my money where my mouth is. Right now, I'm looking for property too, because it's a perfect time to buy property. You're gonna have a perfect time to go and actually get something, like for a house, for example. And this is where I see, like, everybody's kind of complaining about prices going up. Price for milk has gone through the roof, for them eggs, everything's gone up right now. If I told somebody this car here that was 25,000 last year is $20,000 today, nobody's gonna wait for it to go down another 5,000. They're gonna be like, that's an amazing deal. And a car is a depreciating asset. A house is much different. And so that's why I always argue this is the one area in the economy where your dollar is actually gaining value. So for the down payment, it's gaining value for you to get into a new home. You cannot see that anywhere else. So now is the time to kind of jump in.
Yeah, 100%. And I think that, I don't want it to. So this should be a positive podcast because there's opportunity. Yeah. I want everybody to understand this, right? And I don't want to dump on the doom and gloom.
Yeah.
But there's a governing body called OFSI, which is the Office of Superintendent for Financial Institutions, and they're actually looking at making additional changes to make it a little bit more difficult to borrow money. And they're looking at basically a few things. One would be the maximum debt to income. So it'll be above and beyond your lending ratios or the stress test and everything else. And right now they're just going through it right now to see if they're going to implement some of these things or not, because this would affect, because when we qualify individuals for a mortgage, we have to use a stress test. Okay. And a stress test basically, whatever your rate you're going to be getting is 2% above that rate. Okay. So what's happening right now as a variable, where those rates right now, that's, close to 6%, let's say, for example, we have to use 8% to qualify you. But if you have a mortgage, you're getting at 4.79, we use 6.79. Okay. So you actually qualify for more of a mortgage by using a fixed, whatever the lower rate is, you'll qualify for more. Now, this is all financial institutions that are governed federally. So if it's a credit union, okay, they're governed provincially. So they are not bound by the same regulations. So when we have a credit union, we can often qualify at whatever that contract rate is. So we can actually qualify for more with a credit union sometimes. But my point is that they are looking at making some more additional changes that could potentially make it a little bit more difficult to actually borrow. Okay. Which is, again, a good reason why right now would be a very good time to even if you were on the sidelines for a while, get back into the ring, see where you are right now. See where you are with these other options, these new programs that have come out to help home buyers as well. Because it could get you in there sooner.
Yeah, no, and just to kind of address something that you just kind of said earlier, I'm not about the doom and gloom. I'm very enthusiastic about where the market's going. I want everybody to kind of buy. I'm like, anybody comes in, I'm like, listen, don't think about it. Just start preparing. You don't have to jump into the market now, like today, but start preparing. Look at where you are and how you can get in. So to that effect, I guess my next question then is given the changes that you're kind of you just spoke about, given the markets, all of that, for first-time home buyers or even repeat buyers, what's the best thing that they could do? What's the best first step that they could take today in their approach to real estate, whether they should be buying or making that decision? What's that first step that you advise Canadians in this position to be taking?
Yeah, I think the very first step is to reach out to a mortgage broker, right?
Yeah.
Because the one thing think of us as a coach, your home buying coach, because one of the things, and sorry, some people might say, well, why wouldn't I just go to the bank and everything else? And we can address that separately. But understand mortgage brokers work with multiple different lenders. Um, you don't pay for a mortgage broker, like the
Yeah.
lender pays when so you're leveraging somebody, like having a representative that's going to look out for you. And the thing is everybody kind of fits like a different puzzle. Like not everybody is shaped the same.
Yeah.
And so when I come across somebody and there might be maybe credit challenges or down payment challenges, or maybe some of the money is overseas, how do we get it over here? How do we use it? Things like that. Everybody's kind of different um,
Mm.
complexities in terms of what there is. So our role is to say, okay, how do we take you from where you are right now to where you want to get to? And what steps do we need to do? Right. There's new programs, like they have the new first home buyer savings account, right? Which now
Mm.
you can contribute $8,000 towards that particular account. Okay, each year, it's deducted off your income just like it is off a RSP. Okay,
Oh,
and
wow.
I can still contribute to the RSP too, right? So I can do 35 up to 35,000 RSP. I can do up to 40,000 in this, but the difference between this one when I buy the home is I don't have to pay this one back, right? So there's how do you start to RSP season's coming up, or I guess it's already over, but leveraging your tax refunds and everything else to try and accumulate more of a down payment,
Yeah.
like just the strategies, like meeting with the mortgage broker, I think is really, really key. Some people get so excited they call the realtor right away. It's like, you start showing me homes, right? You get this home, it's like, it looks beautiful. I
Yeah.
have no idea if I can afford it or not, right? So and then like there's other things where, for example, income might not quite be there for what you need, but maybe you can bring in a guarantor, maybe a parent can co-sign, things like that would help elevate um, your level that you can borrow, as long as the affordability is there, right? So and that's important too, because you don't want to be house poor. You want to be able to, you
Yeah.
know comfortable, right? And make sure the budgeting is done. That's what a mortgage agent would do that with you as well, right? To make sure that you budget, exactly, what it would mean
Yeah.
to transition into a home.
Yeah. No, yeah, 100%. I mean, I find whenever anybody's asking me, I always say mortgage brokers, because I find that it's the one place where they're there for the rest of your life. I know that we're just talking about that first property, but
Yeah.
like if you go to a bank, and I love banks, I don't have anything against them, but if they're good at what they do, when it comes to renew, that person may not be there. Whereas if a mortgage broker is good at what they do, they're going to be there, and they're going to be able to advise you on your next step, your investment property, if it's your first one, your second one, your third one, your cottage, whatever it is, you need something, you need a credit line for your kids to go off to college, whatever it may be. The mortgage broker understands, and they're not limited to, like you just said, one bank. This is the only thing I could give you, right? It could be your first mortgages from one place, your credit lines from somewhere else. You're optimizing it so that overall, the name of the game is to build wealth, and you need the right people behind you, that are making sure that you're actually making sure that your dollar is going the furthest, because I'm sure nobody who's listening has an unlimited amount of money, unlimited amount of wealth. You're trying to figure out where you're going to bring how much you're earning, where's it going to go the furthest. So I always say, if you don't have a mortgage broker, you should, because that's an advisor that you stick with for the rest of your life. It's one of the biggest part, like your home ownership for most Canadians is 80 to 90% of their wealth. So it's something that they need to really, really take seriously, as opposed to kind of dropping to the bank that they know. And not, again, nothing wrong with the bank, but you don't know if you're getting the best product that fits. So that's why I always say mortgage broker all the way. And again, if anybody is really looking into this market, even if you're considering, like you just said, like they should be reaching out, making sure where their finances is, what they can afford. The other thing is even for those people who are waiting for the market to hit bottom and they're going to somehow figure it out. If that's when you start the journey, you're definitely going to end up nowhere. You need to have all your ducks in a row ahead of time, so that when you find that right property, you can snap it up right away. And that's why I always say reach out to a mortgage broker, because it can actually give you a good understanding of what you can afford.
Yeah, absolutely. And I think that, you know what, it's one of the biggest investments of your lifetime, right? So, and I always think of, as a mortgage broker, it's my responsibility to help you manage that debt throughout that lifetime.
Yeah.
And just like you said, because you might be focused on that first home, but then you're going to find after building wealth through real estate is one of the best ways you can build wealth. And all of a sudden, what you never would have thought, within 5 or 10 years, now you're thinking about maybe your first investment property, right?
Yeah.
Other things that are going to help build wealth for your family and give you financial peace of mind and financial freedom sooner, right? And that's why for us it's so important that we try, it's talking about, listen, how do we get you into homes, right?
Yeah.
That is really, really critical, because the wealth we can build through leveraging real estate within a much shorter period of time is probably easier than, I don't know of any other investments that
Yeah, no,
are
it outperforms
right.
pretty much all of the asset classes. Not all, but majority of them, and it's the best way. It's most accessible for most people, and so definitely something people should consider. You know what? Perfect way to wrap up this podcast. I appreciate you coming on, Lorne. For anyone who's listening and wants to speak to Lorne or anybody on the team, I'm gonna have his contact information below or on the side, depending on where you're listening from. Appreciate your time. Any last words before we sign off?
You know what? No, I appreciate you having me on here. And like I said, there's an opportunity to even reach one person that sort of gives them a spark that says, okay, maybe it's amazing how when we connect with somebody, they thought it was like years away. And all of a sudden within 6 months, they buy their first home,
Yeah.
right? Because they just didn't know. And that's why it's so important to have your coach, get your mortgage
Yeah.
broker on your side, have them understand you and your goals, and then come up with a plan. And it can happen a lot sooner than you think.
Awesome. Thank you. Thank you for coming on.
My pleasure. Anytime.